Hi, and welcome to Advanced Fixed Income, Not Your Grandfather's Bonds, the latest in a series of educational webinars developed by IndexUniverse.com. I'm Matt Hougan, editor of the Exchange Traded Funds Report, and your host for today's webinar. The format today is very straightforward. I'm going to deliver a 30-minute presentation that will provide a brief overview of what I call modern fixed income investing. My goal is to debunk the myth that all bonds are created equal and make the case that most investors are undermanaging their bond portfolios and missing out on opportunities in the market. I'll also talk a little bit about how you can tap into these broader fixed income markets using ETFs. At the end of my presentation, I'll bring in two distinguished panelists for an interactive audience Q&A. We want this presentation to be as useful as possible, so the slides and a recorded copy of the presentation will be made available on IndexUniverse.com early next week. I'm pleased to be joined today by two of the world's leading experts in fixed income investing and exchange-traded funds. Tom Anderson is the head of strategy and research at State Street Global Advisors, which, as you know, is one of the leading companies in the ETF market and sponsor of some of the largest and most innovative fixed income ETFs available today. Tim Anderson, no relation, is partner and chief fixed income officer of Riverfront Investment Group, an independent RIA firm located in Richmond, Virginia. Tim's focus is on the management of core, core plus, and high yield bond portfolios. Let's get started. Those of you who know me know that I like to start with first principles. So let's begin with this question. What exactly is fixed income? In its most traditional sense, fixed income is a type of investing for which periodic income is received. When you buy a fixed income security or bond, you're lending money to the issuer for a specified period of time. In return, you expect the issuer to make regular interest payments, be it annually, semi-annually, quarterly, or monthly, and to pay back the face amount of the bond on the maturity date. The coupon, or interest payment, is set at issue and remains the same until maturity, thus the term fixed income. Now, conventional wisdom says that people should invest in fixed income either to create a cash payment stream or for overall portfolio diversification, and both points are valid. But I'm going to argue today that the common conception of fixed income, both how to build a fixed income portfolio and what role it can play, misses out on opportunities. I'm going to argue that most fixed income investors today are approaching the market the way equity investors approached the market 15 or 20 years ago, and that new tools allow us to build better bond portfolios than ever, and to take advantage of short-term tactical trading opportunities as well. Now the rule that we all learn is that every investor should own some bonds in their portfolio. And the data show that, at the very least, fixed income is very prevalent. According to the ICI, at the end of 2008, there were more than $1.5 trillion invested in fixed income mutual funds in the United States. Institutions play an even bigger role in the fixed income market. The precise size of the global bond market is difficult to pin down, but a 2008 study by McKinsey Global Institute estimated it at about $79 trillion, including both government and private debt. The same McKinsey study pegged the global equity market at $65 trillion, or about 20% smaller than the bond market.